I'm Brittany Lewis with Forbes Breaking News. Joining me now is Stephen Mathai-Davis, the CEO and founder of Q.ai. Q.ai is a next-gen AI-powered investing app that's backed by Forbes. So Stephen, thank you so much for joining us today.
Thanks for having me on, Brittany.
Of course. So first, can you give us an overview of what the app does?
Q.ai is bringing institutional-grade investing to the average individual investor. Our mission is to bring best-in-class investing and wealth management to modern investors through a one-tap investing model.
Okay, and so when we talked last week, stocks wrapped their worst first half of a year since 1970. This also came as the S&P 500 remained in a bear market territory since mid-June. But the jobs report that was released today showed the labor market added 372,000 jobs in June. And yesterday, we saw the stock market move higher one day after the Fed reaffirmed their commitment to bring down inflation with more big rate hikes and tighter monetary policy. So we'll get into Fed news later,
Sure.
But first, can you kind of give us an overview of the market landscape for us?
Sure. As we talked about last week, coming into the year, we were very bearish. Looking into the second half of the year, I wouldn't say we're bullish, but we're not as bearish as we were previously, and we actually think stocks are going to actually drift higher over the next few months. Look, at the end of the day, when you look at valuations where they are today, the S&P 500 is within its 5 to 10 year average on a forward 12-month PE basis, trading around 16 times. And the labor reports actually reaffirm what we've been talking about, which is we're not heading necessarily towards a recession now. We're not arguing for go growth, but we're not heading towards a recession either. I'm sure we'll chat about that in a little bit, since that's been a theme that we've been pushing quite a bit.
Of course, yeah, so I will ask you about a recession in a little bit, but I want to talk about continued inflation. So because of inflation, there are these looming recession fears that we have discussed at length. And so last week, S&P put the odds of a recession in 2023 at 40%. So this is higher than what Morgan Stanley predicted, which was 35% at the end of June. So to that point, let's talk about the updated BEA report that was released last week. So this report showed the economy in the first quarter of this year posted its worst annualized showing since the pandemic-induced recession of 2020. So GDP declined by 1.6%, but GDI is up by 1.8% in the first quarter. So first, can you elaborate on what this means?
Sure, let's start off. GDI and GDP are supposed to be measuring the same thing, which is economic output. GDP is doing a top-down analysis of economic output. GDI is doing a bottom-up.
Sure.
They're theoretically supposed to converge, but when they're different, typically GDP tends to converge towards GDI. Now, GDI was on an annualized basis in last quarter, 1.8%. If you look at the two combined, it was up 10 basis points on average. And that's pointing not towards a recession. Now, it's pointing towards a deceleration in economic growth. Now, keep in mind, final sales to domestic purchasers, which is a measure of domestic demand, was up 1.6%. So this is pointing towards a lot of health in the domestic economy in the U.S.
Okay, great. And so what I'm hearing is that you don't think we're headed towards a recession. I asked you point blank if you think we are headed towards a recession in our Twitter Spaces conversation earlier this week. You said no. So can you point to other data points or indicators that people can look to see if we are headed to a recession?
For us, it's not about whether or not we think we're heading towards a recession or not. It's the empirical evidence would suggest we're not. Now, specifically, if you look at retail sales, they were very strong in May. We haven't gotten the June print quite yet, but it was up 50 basis points period over period. That doesn't point towards a recession. And consumer demand continues to be strong. Now, no one's arguing for an acceleration in economic growth.
Sure.
We're just saying that the evidence does not suggest we're heading towards a sharp recession.
I want to talk about the Fed's latest policy meeting. According to minutes from the Fed's June meeting, Fed officials reaffirmed their commitment to fighting inflation with big rate hikes. They pledged to use a, quote, more restrictive policy as needed, and this comes amid a large risk that high consumer prices could become entrenched for longer. So Fed officials did agree that while tightening monetary policy could slow economic growth short term, it's critical for fighting inflation in the long term. And this is all coming after the Fed authorized the biggest interest rate hike in 28 years in June. So experts have worried that this rate hike could send us hurtling into a recession, but Fed Chair Jerome Powell said that another 75 basis point increase is under consideration for July. So with all of this news coming out of the Fed, I have a few questions for you. So first, can you break it down and elaborate what this all means?
Sure. Listen, and the argument that higher interest rates will lead to a recession, that's a textbook answer, right? That's what you learn in Eco 101. The reality is rates are pretty low.
Sure.
This is not the 1980s where they're in double digits. Rates were on a real basis in negative a couple of years ago. So I'm not sure interest rates increasing rapidly will lead to a recession. There are other factors that might impact that, specifically the Fed purchasing of assets decelerating over the next several months, which is what they've kind of pointed towards. If you have a dry up in liquidity, right, that could impact economic growth.
Okay, so do you think these interest rate hikes are the move to combat inflation, or do you agree with people who say that they can send us into a recession? So you're seeming to say no.
I think there are risks with what the Fed is doing. I do think the Fed is being reactive, not proactive, right? So there's always a danger in being reactive. But do I think 75 basis points interest rate increase in the next month or 2 months is going to push us towards a recession? No, because the evidence doesn't point towards that.
Okay, and on the topic of inflation, I want to discuss an admission from Treasury Secretary Janet Yellen from earlier this year. So in an interview with CNN at the end of May, she conceded that she was initially wrong when it came to inflation. So as you remember, in March 2021, she said inflation only posed, quote, a small risk. So flash forward to present day, we have seen inflation hit 40-year highs. So because of that misstep, do you think that trust was lost in the current administration's handling of inflation?
It's a great question, and it's a really important point. It's coming back to what I said earlier. The Fed, as well as the Treasury Department, they have been, let me say this again, it's economists. That's a great question, and I think the core point really has been that the Fed and just other economists in general have been more reactive than proactive in terms of looking at inflation. And what's been driving their decision making is when you think about GDP growth mechanically, it's driven by labor productivity, it's driven by capital, and it's driven by technology advancements. And I think people got too focused on the impact of technology driving economic growth and how inflation itself would be transitory. I'm sure you've heard that said before. And that's a function of technology and the impact of technology.
Sure.
And I think people lost track of that, especially thinking about the impact of fiscal policy on price growth.
Mm-hmm. So as we're talking about the Biden administration, as you know, Forbes Breaking News covers politics extensively, and the economy is a huge talking point as the midterms are coming up. So according to a new Monmouth poll, almost half of Americans say either inflation or high gas prices are the biggest concern when it comes to their family. So knowing economic strains are at the top of mind to voters, GOP lawmakers have been blaming Biden administration economic policies for these high prices, record high gas prices. So Democratic lawmakers have largely rebuffed, and they blame the high prices on either supply chain issues from the COVID-19 pandemic or Russia's war in Ukraine. So where do you think the blame falls when it comes to these red hot consumer prices?
Yeah, that's a great question. So it's funny because I know you're asking for one or the other, and I can't give that definitive answer from my perspective. It's a combination of the two. You've had supply chain issues coming from COVID. Listen, you have the impact of tariffs as well on price growth that nobody's really talking about, but naturally tariffs drive an acceleration of price growth. And then 3, you've got the policies of the Biden administration and the Democratic Congress that haven't really addressed many of these issues.
Sure, and I want to keep continuing to talk about midterms. So according to current polling, Republicans have an opportunity to take control of the House come November. So Republicans only need to flip 5 seats in the House to gain control of the chamber and only 1 Senate seat. So 50 seats in the House and 7 seats in the Senate remain either a toss-up or extremely competitive for Democrats. So inflation is also at the highest in key battleground states right now, including California, Nevada, Oregon, and Pennsylvania. So with all that being said, let's talk about some hypotheticals leading up to the midterms. So first, how would you predict the economy will respond if Republicans take back the House, both initially and long term?
Yeah, that's a good question. I don't know about long term. I can definitely say short term. Typically, markets tend to rally in a split government situation where the Republicans control Congress and it's a Democratic president. So I would imagine if the Republicans took the House, you'd see markets begin to drift higher again in 2023, irrespective of other factors driving economic growth.
Sure, so speaking of split government, how would a divided government affect the economy, especially in terms of inflation and a potential recession?
Well, remember what's driving inflation is price pressure. So the Democrats wouldn't be pushing through a more progressive agenda, right? Because that would drive price growth, irrespective of your political leanings. That wouldn't get through, and the Republican Congress wouldn't be able to get much through that would potentially impact price growth as well, because you have a Democratic president who could veto quite a bit. So I think it would actually lead to more bipartisanship, which will lead to potentially some policies that would be positive for the economy.
Sure, and speaking of that progressive agenda, could a prolonged recession or long-lasting inflation move President Biden to the right, or do you think that's just a Republican pipe dream?
That's a Republican pipe dream. He's a centrist. So he's what he is. He's been in Congress for how many years? A couple decades. That predates me, since I was born. I don't see that happening.
Sure, and if Biden is seen as a lame duck following a loss in the midterms, will Republicans simply refuse to find any common ground economically and wait for 2024 instead? And if so, how do you think that this will affect the economy?
Yeah, that's a great question. So the Republican Congress is not incentivized to do anything with the Biden administration, especially if they think it's a lame duck presidency. So that's element one there. As it impacts the economy, I think it's a do no harm situation where each party's, at least the more extreme wings of both parties, aren't damaging the U.S. economy. U.S. economy continues to be healthy. It's probably going to continue to trend in this direction that we've been talking about, which is a narrow positive growth scenario. So I think it'll be net positive.
Okay, I'm looking forward to seeing how this all pans out, and I'm sure we'll have plenty of conversations about more hypotheticals leading up to the midterms. So Stephen, thank you so much for joining us today and sharing your market insights and midterm predictions, and I look forward to talking with you again soon.
Cool, thank you for having me on.